If you own an index fund, you own the thing that Wall Street laughed at. And I mean that literally. They had a name for it. They called it Bogle's Folly, because when it launched in 1976, it did not work. The plan was to raise between $50 and $150 million. It raised 11.3. The man who built it did not spin that. He called it, in his own words, an abject failure. In the next half hour, I will show you what he actually built, why the fund was the least important part of it, and why the fee on your account is lower today because of a corporate structure almost nobody can explain. And I want to be careful with one thing from the start, because most versions of this story get it wrong, and the wrong version makes him smaller than he was. Start in 1949 with a student who cannot find a thesis topic. John Clifton Bogle, born the 8th of May 1929, is an undergraduate at Princeton, studying economics and running out of time. He is looking for a subject nobody has written about. That is harder than it sounds, and it is the whole reason this story exists. In the library, he picks up a copy of Fortune magazine from December 1949 and finds an article called Big Money in Boston. It is about mutual funds, an industry that, at that point, is barely covered in textbooks and has almost no reliable aggregate numbers attached to it. Which is exactly what he wanted, not a topic he loved, a topic nobody had counted. He spends the next 18 months counting it. The thesis runs to 141 pages. The title is Dry to the Point of Comedy. The economic role of the investment company. What is inside it is not dry at all. He goes through the long-run returns of the funds and reaches a conclusion a 21-year-old had no business reaching. Mutual funds, he wrote, can make no claim to superiority over the market averages. Read that again with the date attached. 1951, before the index fund, before the research literature that would later prove him right. And he did not stop at the diagnosis. He wrote that the industry's future growth would come from reducing sales charges and management fees, which is, in one sentence, the entire business plan of a company that did not exist yet and would not exist for another 24 years. I find that genuinely strange. Not impressive, strange. He described his own life's work as a student, then went and did something else for 2 decades. He graduated magna cum laude in 1951, and the thesis did one more thing for him before it went into a drawer. Walter Morgan read it. Morgan was Princeton class of 1920, and he had founded the Wellington Fund. He read a student paper that was, in places, unflattering about his own industry, and then he hired the student. I want to flag that because it is the only piece of luck in this episode, and everything else depends on it. A 22-year-old walks into the fund business in 1951 carrying a written argument that the business does not add value. Nobody, including him, does anything about that argument for a very long time. Because being right early is not the same as being able to act, and the gap between those two things is where most of this story lives. He is good at the job. He rises fast. By the mid-60s, he is running the place. And then he makes the mistake that everything else in this episode hangs from. I am going to tell you about it plainly, because he did. He was unusually honest about his own worst decision for the rest of his life. The 1960s in American fund management were what the industry itself later called, without embarrassment, the go-go years. The name tells you most of what you need. Performance funds, star managers with their photographs in the trade press, concentrated bets on fast-growing companies marketed almost entirely on last year's returns. Wellington, where Bogle worked, was none of that. Wellington was a conservative, balanced fund, stocks and bonds in sensible proportions, deliberately and proudly boring. And boring was selling badly. Money was flowing towards the exciting funds, the way it always does at that particular stage of a cycle. And the flows were not close. So Bogle did what an ambitious executive does when his product goes out of fashion. He did not defend the product. He went out and bought the fashion. In 1966, Wellington merged with a Boston investment firm whose reputation rested on an aggressive growth fund called iVest. On paper, the logic was elegant, and I can see why a board approved it. The conservative house acquires a growth arm. The growth managers acquire a national distribution machine. In practice, he had bought the top of a market, and the currency he paid with was his own company's independence. Because the merger did not simply add a fund to the shelf, it brought in new partners, and those partners now owned a piece of the management company itself. Which meant that from 1966 onward, the question of who actually controlled Wellington had a complicated answer, and complicated answers get tested eventually. Then, the 1973 to 74 bear market arrived, and aggressive growth funds did the thing that aggressive growth funds reliably do in a market like that one. iVest, the fund the whole deal had been built around, was eventually wound up entirely, not repositioned, not merged away. The strategy simply did not survive. Bogle later described that merger as the biggest mistake of his career, and he said so in public, repeatedly, unprompted, for the next 40 years. I want to sit on that for a moment because it changes how you should read everything that comes after it. The man who ends up as the patron saint of simply buying the whole market spent his 30s chasing performance. And he chased it badly at the worst possible moment in the cycle. He is not in the story because he was born with unusually good instincts. He is in it because a mistake cost him everything he had built, and then he sat down and read the receipts. By 1974, the board of the management company and the boards of the funds themselves were, in every practical sense, at war with each other. The partners he had personally brought in during the merger held the votes, and in 1974, they used them. John Bogle was fired as chief executive of Wellington Management from the company he had walked into at 22 and spent 23 years inside, at 45 years old. Publicly in a small industry where everybody knew, over a deal that had been his own idea from the beginning. That is normally the end of a career. In almost every version of this story, that is exactly what it is, and you have never heard of him. What happened instead depends entirely on a technicality, and I need to explain it properly, because the technicality is the actual invention in this episode. A mutual fund is not one company, it is two, and they are easy to confuse. There is the fund itself, which is a pool owned by its shareholders and governed by its own board of directors. And there is the management company, which is a separate business that the fund hires to run the money and market itself. The management company is the one that makes a profit. The fund is the one that pays it. Which means the fee you pay is not a cost of running the fund. It is a cost of running the fund plus somebody else's margin. That structure is completely normal. It is how essentially the whole industry was built, and it is how most of it still works. And here is the technicality. Bogle had been fired by the management company. He had not been fired by the funds. The funds had their own boards. He still had support on them, 2 organizations, 2 decisions. So he made an argument to those fund boards that sounds modest and was not. Let the funds employ their own staff. Not to manage the money, just to handle administration, the paperwork, the record keeping, the unglamorous half. The compromise that came out of it in 1974 gave Wellington Management the portfolio management and the marketing and kept its name. And it gave the funds a new independent company of their own to do everything else. That company needed a name. The name they chose was Vanguard. It was incorporated in September 1974 and began operating in May 1975. I want to be exact about what had and had not just happened, because this is where the popular telling goes wrong. Nobody in that room was designing a vehicle for index funds. Nobody was thinking about your fees in 2026. It was a settlement. A demoted executive was given the boring half of a business as a consolation prize. But look at what the boring half actually was, because the ownership had inverted, and I do not think anyone fully saw it yet. Vanguard was owned by the funds. The funds were owned by their shareholders. So Vanguard was owned at the end of the chain by its own customers. There were no outside stockholders. There still are none. There is no one standing outside the structure waiting to be paid, which means Vanguard can run the funds at cost, not as a promise, not as a marketing position, as an arithmetic consequence of who owns it. A normal management company that cuts fees is giving up its own profit. It can do it, and it will resent it, and it will stop. A company owned by the funds that cuts fees is just returning money to its owners. There is nothing to resent. It never has to stop. That is the invention, not a product, a place to stand. And it explains something that otherwise looks like magic, why the fees kept falling decade after decade without anyone forcing it. Vanguard reports an average expense ratio across its funds of around 0.08%, against an industry average mirror 0.5%. Hold those two numbers next to each other. They are not competing prices. They are two different answers to the question of who the company works for. Now, the structure exists in 1975, and it does administration only. It is explicitly not allowed to manage money, which is a problem because a company that only does paperwork has no future, and everybody involved knows it. Bogle needed a product, and it had to be a product that could plausibly be described as not being managed at all. Which brings us to the most useful academic paper ever aimed directly at a man who was ready to act on it. In the autumn of 1974, the Journal of Portfolio Management published its very first issue. In it was a short piece by Paul Samuelson, the first American to win the Nobel Prize in Economics, 3 pages. Pages 17 to 19. It was called Challenge to Judgment, and it was not written politely. Woo! Samuelson wrote that a respect for evidence compelled him to incline toward the hypothesis that most portfolio decision makers should go out of business. He suggested they take up plumbing, teach Greek, or help produce the annual gross national product by serving as corporate executives. That is a Nobel laureate in the launch issue of a professional journal telling the profession it should consider other work. But the part that mattered was not the insult, it was the request underneath it. He asked that some large foundation set up an in-house portfolio that simply tracked the S&P 500 index. Oh! Not as a business, as a control group, something to measure the professionals against. He was asking for a benchmark that could not make excuses. And he said, in effect, that nobody would build it because nobody had an incentive to. He was almost right. Everyone who could build it made their living from it not existing, except for one man who had just been handed a company that was forbidden to manage money and needed something to sell. Bogle read it. He said afterwards that it caught him at exactly the moment he could do something about it. And here is where I have to slow down, because this is the claim that gets exaggerated in every retelling, including by people who should know better. Bogle did not invent index investing. That is not a small correction. It is the difference between a myth and what actually happened. By the early 1970s, index strategies already existed for institutions. Wells Fargo ran one. So did Batterymarch. So did American National Bank in Chicago. Big pension money could already buy the market. The idea was in the air, in the journals, and in practice. What did not exist was a version an ordinary person could buy on a Tuesday afternoon with a few $1,000s. So the thing Bogle actually did was narrower than the myth and, I would argue, harder. He took an institutional idea, put it in a retail wrapper, and this is the part that mattered. Put it inside the one company on earth that could not mark it up. An index fund sold by a normal management company is a low-cost product with a profit margin bolted on top, and that margin eats the entire advantage. An index fund sold at cost is a different object, same portfolio, completely different outcome after 30 years. The structure and the product only work as a pair, which is why it took a man who got both, by accident, 4 months apart. The fund was launched on the 31st of August, 1976, under a name that has since been quietly retired. First Index Investment Trust. It was the first index mutual fund made available to ordinary American investors, and it tracked the S&P 500, exactly the index Samuelson had named, 2 years after he named it. The underwriting was expected to bring in somewhere between $50 and $150 million. That was not a stretch target. That was the plan the launch was built around. It brought in $11.3 million, less than a quarter of the low end of the range. And Bogle's own verdict on it, given decades later when he could have said anything he liked, was that it had been a complete flop and that the launch was an abject failure. Not a slow start, not a difficult market. Those are his words about his own product, said out loud on the record. Meanwhile, the industry already had a name ready for it, which is how you know they were paying close attention. They called it Bogle's Folly. And you have to understand why the reaction was contempt rather than indifference, because contempt is, in its way, a compliment. Indifference is what you get for something irrelevant. The pitch was structurally an insult to every single person who sold a fund for a living. It said, we are not going to try to beat the market, and neither, in aggregate, are they. A brokerage had no reason on earth to sell it. There was no sales load worth having, no story to tell a client, and nothing at all to promise. It could not be marketed on last year's performance either, because by definition, it was never going to have any performance worth putting on a poster. It would match the market. That was the entire feature. So from a sales perspective, it was a product with no story, and its whole proposition was a piece of arithmetic that pays out over decades. Arithmetic is the worst sales tool in the world at the moment of sale, and the best one in the world 20 years afterwards. Almost nothing in finance is built to survive that gap. So the fund just sat there, small, unloved, quietly tracking its index, while the rest of the industry moved on to considerably more interesting things. And there is an obvious version of this story where that is simply the end of it. An underfunded product, closed quietly in 1979, a footnote in somebody's history of the fund business. It did not die. And the reason it did not die has nothing to do with the fund and everything to do with the ownership structure again. Vanguard had no outside shareholder to face. Nobody was sitting across a table asking why the company was carrying an $11 million fund with no sales momentum and no path to a decent margin. Nobody had to be persuaded the fund would eventually turn a profit, because the fund had not been created to make a profit. It had been created to be cheap. A publicly traded competitor kills that product in year 2. I do not think that is even a close call. There is no version of that quarterly review where the index fund survives the meeting. So the honest answer to why it survived is not vision, and it is not conviction, and it is certainly not courage. It is that there was nobody in the building with the standing to kill it. I think that is the single most useful sentence in this whole episode, and notice that it is a sentence about governance rather than about investing. Now let me show you the machine that was quietly running underneath the boredom, because it is the whole argument. Take 2 funds, same holdings, same market. The only difference is what they charge. One charges 0.5% a year, the other charges 0.08%. That gap sounds like nothing. It is roughly 0.4% a year, less than the market moves in an average hour. But it is not a one-off charge. It is taken every year from a balance that is supposed to be compounding, and so it compounds too. You are not losing 0.4%. You are losing 0.4% plus all the growth that money would have produced for as long as you hold it over a working life. That is not a rounding error. It is a meaningful share of the final balance, and it is deducted whether the market rises or falls. And here is the part that makes it uncomfortable rather than merely interesting. It is the only variable in the whole system you actually control. You do not control returns. You do not control inflation. You do not control the sequence in which good and bad years arrive. You control the fee. It is knowable in advance, it is identical in every scenario, and it is the one number that is certain before you start. Bogle's argument was never that the market always goes up. It was that costs always come out. which is why he was temperamentally so hostile to the idea of picking winners. Not because it is impossible, because it is expensive to attempt. The fund itself performs the way an index fund performs, which is to say, unremarkably, year by year, and then remarkably in aggregate. Over its first 20 years, assets in it compounded at an annual rate of about 53%. I want to be precise about what that number is, because it is easy to misread, and it is not a return. That is the growth of assets in the fund. Market gains plus everything new investors put in. It measures adoption, not performance. And adoption is the right thing to measure here because the argument was never about a clever product. It was about whether anyone would take a cheap one. Slowly, and then not slowly, they did. The thing nobody would buy in 1976 became the default in a way that is now almost invisible, which is how you can tell an idea has genuinely won. Not when it is celebrated, when people stop noticing they are using it. Meanwhile, the man himself had become, in tone, less like a fund executive and more like a preacher with a spreadsheet. He kept saying the same handful of things for 4 decades. Costs matter. Time is your ally. Do not confuse activity with progress. It is not a complicated body of thought. It never was. That is the point of it. And it was said throughout by a man whose company was structurally incapable of profiting from him being right. He got very little of the money, which is the detail that turns the last part of this story from a business anecdote into something else. In February 2017, Warren Buffett published his annual letter to Berkshire Hathaway shareholders, the one covering the 2016 year. It is one of the most widely read documents in all of finance, and Buffett spent part of it talking about a man who was not a Berkshire employee, not an investor in it, and not a partner in anything he owned. He wrote that if a statue is ever erected to honor the person who has done the most for American investors, the hands-down choice should be Jack Bogle. He noted that for decades, Bogle had urged ordinary investors into ultra-low-cost index funds and had kept saying it long past the point where anyone would have thanked him for it. And then he added the line that actually does the work, that Bogle amassed only a tiny percentage of the wealth that is typically flowed to managers who promise their investors large rewards while delivering them nothing of added value. I would ask you to read that as the accounting statement it really is. The most consequential person in the entire industry was also among the least compensated by it. And that was not bad luck. It was a design decision he made and then refused to reverse. Buffett also recalled in the same passage that in his early years, Jack was frequently mocked by the investment management industry. He is describing that same nickname, Bogle's folly. And I think Buffett put it in the letter deliberately, because in a story like this one, the mockery is not a detail. The mockery is the proof. John Bogle died on the 16th of January 2019. He was 89 years old. He had spent 68 years arguing a single case that he first wrote down as a student, in a thesis that nobody would ever have read if one Princeton alumnus had not happened to pick it up off a desk. And I want to close the loop on the honest version of what he did, because I promised you at the start that I would not inflate it. He did not discover that active management underperforms. Samuelson and others said it earlier and more rigorously. He did not build the first index portfolio. Institutions had them years before he launched. What he did was take an argument that everyone with power had a reason to ignore and build the one kind of company that had no reason to ignore it, and then survive being ignored for long enough that the arithmetic became visible to everyone else. That is a smaller claim than inventing the index fund. I think it is a much more interesting one, and it is the one the evidence supports. So let me turn all of that around and point it at your account, because this is not a history lesson if it stops here. The uncomfortable implication of Bogle's whole career is that the fund industry is not primarily a performance business. It is a distribution business. Products are not built because they are good. They are built because they can be sold. And the things that make a fund sellable usually make it expensive. A story is sellable. A star manager is sellable. Last year's return is extremely sellable. Arithmetic is Not. Which is why the best marketed fund in any category is very rarely the cheapest one, and why that is not a coincidence. Now, none of this makes the whole industry dishonest, and I want to be fair here because the incentive is structural rather than moral. A management company owned by outside shareholders has an obligation to those shareholders. Cutting your fee is not a thing. It is free to do. It is not that they will not. It is that when the pressure comes off, they will stop and you will not be told. Which is why Bogle's answer was structural too. He did not ask the industry to behave better. He built something that did not need to. And that gives you a question you can ask about any provider, which has a real answer and is not a matter of trust. Who owns the company that manages this fund? And where does the profit from my fee end up? If the answer is outside shareholders, that is not disqualifying. It is just information, and it tells you which direction the fee will drift when nobody is watching. The second thing his career gives you is a defense against a very specific kind of mistake, and it is the one that cost him the 60s. He chased a hot strategy at the top of a cycle by merging with the people who ran it, and it nearly ended him. The fund that was easiest to sell in 1968 was wound up. The fund that was impossible to sell in 1976 is in half the retirement accounts in America. Popularity at launch told you nothing. It has never told you anything. It is a measure of marketing budget, not of merit. And the last thing is the benchmark itself, which is the piece people skip because it sounds obvious and then never actually do. Samuelson's request in 1974 was for a control group, something to measure against that cannot make excuses. You now have that for free in about 4 clicks. The index is the thing to beat, and if you are not comparing against it, you are not measuring anything. So here is what I think you can actually take from this and use, and there are 4 of them. 1. Cost is the only variable in your portfolio you control with certainty. Every other number is a forecast. That one is a fact, in advance, in writing. 2. Ask who owns the company that sells you the fund, not to catch anyone out, to know which way its fees will drift over 30 years. 3. A product's popularity at launch tells you nothing about its merit. Bogle's Folly raised $11 million. The fund everyone wanted in that era no longer exists. 4. Pick your benchmark before you invest, not after. If you cannot say what you are trying to beat, you cannot tell whether you did. And underneath all 4 is the same idea, which is the one he spent 68 years on, and which is not really about money. You cannot control outcomes. You can control structure. So put your effort into the part that holds still. He wrote the thesis in 1951. He got fired in 1974. He launched a flop in 1976. And the argument that everyone laughed at is now so ordinary that most people using it have never heard his name. Which, given what he built and how deliberately he refused to profit from it, is probably the ending he would have chosen. Next time on Legendary Investors, the opposite man in every possible way. A code breaker and mathematician who thought markets were a signal processing problem, hired no economists, and built the most successful fund in history. Jim Simons and a machine that beat the market so consistently that the only honest question left is whether you and I were ever allowed to. Bogle said you cannot beat the market. Simons did, for 30 years. Next episode is about how both of those can be true. If this was worth your half hour, follow the channel. That is the whole thing I asked for. I will see you in the next one.